Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, September 14th, 5:07 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend that kicked off on 8/29 with an O'Neill follow-through day. Limited follow through to the follow through day. That's why we've got weak preference prefacing the uptrend description. But if we get another day like today, we might be able to take that off of the market state. Check the trend gauge over here. Market leaders bullish. Week the prior 2 days. Today, I would give them about a B minus, not massive strength out of any of the leaders, not breaking down either. We've got two of the 21 testing the 21-day moving average. One of them has broke, one has is sitting right on it. We'll see what tomorrow brings when we update the weekend 21 over 21, which we do every Friday. Now, as far as the five major indexes go, and how are they relative to their short-term, medium-term, and long-term moving averages? Mixed bag across short-term. We did have the Dow and the S&P with their rallies today get back above the 21-day moving average. Mid caps and small caps still below. NASDAQ 100 has been living just above there, gave a little bit of room between there, the 21 and today's close. Same situation for the medium-term 50-day moving average. Dow and S&P got back above those levels. S&P has been here before, multiple times playing ping pong. Mild change in the slope of the line for these. They're now turned up ever so slightly. That's a good thing. Mid and small caps still below their medium-term 50-day moving average. Bottom line is that we're neutral across both of those time frames. Long-term, nice bounce for small caps off of their 200-day moving average today. Got rid of the yellow sub arrow in the notation that we had weakness there. Just green for the five major indexes versus the long-term 200-day moving average. That makes yesterday's low on the small cap index very critical, as it closed basically right on the 200-day moving average. So what happened today? Headwinds. What headwinds? So before the market yesterday, we had a slightly hotter than expected CPI number, and the market was volatile but still in a tight range yesterday, but basically shook it off. Today, we had a CPI number that on its face looked like it was going to cause the market to go down hard, but further diving into the numbers on PPI, came out at 8:30 Eastern time, and they were kind of a mixed bag, but the market completely shrugged them off and actually moved slightly higher going into the open. Couple that with higher yields and a stronger dollar, and the expectation, as those have had negative correlations lately with stocks, but not today, the market completely shook them off and had a broad rally. All 11 of the spider sectors green today. Still in the 12-day trading range that since the follow-through day. So that's, a little bit of I really shouldn't have that as green. Let's change that back to more of a neutral color. We're still trapped in there, but definitely a good reaction today, and it happened at a pretty key level with the small caps sitting right on the 200-day and the S&P unable to get above the 21 and 50-day moving averages for more than a single day at a time. But definitely what the bulls dialed up today, at least for what the final numbers are. Under the hood, like I said, leaders were kind of a meh, but actually I promised that I would never say meh, but I just did. Anyway, RG8, here are the final numbers. RG8, our 8 growth ETF composite, kind of disappointing. FFTY, the IBD, it's thinly traded, but it's probably the best reflection of what leaders are doing. That's one of the 8. That was barely up today. The second one that we look at is ARK-K. That was up less than the market today. Those two are the true sign of risk on, and they underperformed today. And as a result, the RGA was just basically in line with the indexes, up 0.85%. S&P 500, the gap up was 0.55% off of PPI this morning, pulled back, and then three waves up into the late afternoon. Nice final number, up 0.84%. NASDAQ 100, weaker for most of the day. It gapped up 0.6% and then immediately got weaker relative to the S&P, but gathered some strength mid-afternoon and closed basically in line with the S&P, also up 0.8%. Dow Jones Industrial Average up nearly a full percent. Mid caps and small caps shine today. Good time for them too. They've been lagging. Mid caps up 1.2%. Russell 2000 small caps up 1.4%. Global 60/40 stock and bond up 0.56%. Bonds kind of in a tight range today. Certainly lagged overall stocks. In-house GROTECTION up 0.84%. Our two biggest individual stock positions, Uber and Nvidia, underperformed relative to the S&P today. Otherwise, we would have had a nicer number, but still basically in line. Actually, I think this is 0.83%, not 0.84. We'll take it. We're positioned. We're happy with the way we're positioned. We've got cash available to put it in. If some leaders jump up and say, "Hey, you deserve to be piling money into me," and right now we're only taking small positions and not getting a whole lot of positive feedback from them. But then again, we're not getting a whole lot of positive feedback from the market as it's been in that 11-day trading range. Make it 12 days after today. We'll take a look at that when we get to the charts. Speaking of which, let's get right in there. So you can see very clearly here on the S&P 500, I drew a triangle yesterday, declining tops trend line, and then uptrend line along the bottom here. That's as clear a breakout of that triangle that you can imagine. On the 60-minute chart, however, we're still in this trading range, closer to the top of it. Most bullish scenario would be we get up to 45.20, 45.30, pause a little bit around there, and then take off to the upside. This might, it's possible that seasonality kicking in at the beginning of next month will help us. We never predict. We watch the markets. We've got all the secondary indicators. We know what they are. Price and volume, though, are the two things that are most important. And certainly today, breaking this triangle was what the bulls wanted to see. Now, will we hold it? Well, that's what we'll see in the following days to come through. This market has disappointed us several times, most notably on Tuesday and Wednesday after we had a nice up day on Monday. Also disappointed on Friday as we had a nice early rally, sell off into the close. But as far as today's performance, we'll certainly take it. If you're a bull and if you're a bear, you fumbled the ball again at the goal line. Same situation as far as the triangle breakout on the NASDAQ 100, not as strong as the S&P breakout. We might back test it, we might not. Again, we don't predict, but that's what we're looking for, bulls. We're looking for this break of this declining tops trend line, and which is part of a triangle, and that's what we got today. So good stuff for one day, but as I said, we've been serially disappointed over the last couple of weeks with the market. So when you least expect it, expect it. Let's move on to the Dow, which had been lagging. Best return of the indexes today, and look at the uptrend line on the Dow over the last week, also breaking declining tops trend line and or triangle breakout. Got it back above the red line, that's the 50-day. The green line, that's the 21-day moving average. So the Dow participating also. Those are the three big cap indexes. Let's move on to the fly in the ointment mid caps. If you're drawing downtrend lines, we broke that one also, but nowhere near as healthy as the breakout. But it is a bounce near the 200-day moving average. That's the black line here. Still ran into or didn't quite get up as far as the 21-day moving average, but that's the next hurdle to be overcome. for mid caps and also for small caps. Again, this is a pretty severe downtrend line, did break it, but still below the declining 21-day moving average. So uh, another day or two like today is certainly what we need for mid caps and small caps to get all five of the major indexes rowing in the right direction. VIX was low coming into today. It got lower. So ever since we've gotten back below this 21-day moving average, the VIX, had a bounce on some weakness in the middle of last week, but this has been positive action today. Every time it bounces it, at least the last 2 days, four of the last 5 days, it's closed near the low range of the day. So this is actually under 13. We're at 1282. I mentioned this 1270 to 1280-ish level yesterday. That's where we're coming into, and that's corresponding with a test in the indexes of trying to get through the highs of this range we've been in. Um, the fact that we're at support here, it's in line with the fact that we're approaching resistance on the indexes, but we'll see who wins. As I said, we don't make predictions here at Revere. We follow the William O'Neill mantra: predictions are futile. Follow the price and volume action of the indexes and the leading stocks, and position accordingly. Here's one of the headwinds that we were facing today: the dollar gap up and closed at the high of the range, and the markets just simply did not care. They might care at some point, but they didn't care today. And it's not a given, it's not 100% of the time that the dollar and the markets go in opposite directions. There have been plenty of times that the dollar and the U.S. markets will move in sync, and usually that means that money is just flooding from other countries coming into the U.S., bidding stocks up as well as bidding the dollar up. Might be the situation that we're in right now. We don't know for sure. How did gold do relative to that? Well, it closed at the top of the range, gap down along with the strength in the indexes, but hey, at least it closed positive. Although on a relative basis, gold is still not looking too good. Gold stocks looked like, with that return up 1.4% on the day, you'd have thought that the dollar was down. So maybe some money flowing into gold stocks finally. Silver, not so fortunate today. It finished down 1%, although it did close near the top of the range. Bitcoin had been struggling recently as of Monday with that big move down, but some strength over the past 3 days, and actually a close above. This is the Bitcoin futures ETF, a close above the declining 21-day moving average. Last time we tested it was after this big move up 2 weeks ago. Let's see what happens with it being up 2% today if we can stay back above it. Let's flip over to bonds now. The broad bond index down 0.17%. Global bonds were basically flat, but we ran in on the price again to the declining 21-day moving average on the broad bond index. TLT, the long bond, down 0.72%. So it's at the bottom of this range, just the opposite of how we're at the range um, in in stocks, and that is kind of a reversal of what we've been seeing lately. So let's look at the TYX. With stocks at the top of the range, we normally hadn't had yields at the top of the range, but that's what we're seeing right now, and forming a triangle. Bonds and stocks, they can change their correlations also, and that, at least for a day, is certainly what happened today. TNX, the 10-year, also up near the top of its range. Tried to break out of the top of the range, but failed yesterday. But over the 2-week range, at least, trying to test the highs of that. So that's the inter-asset correlation we do every video. Let's go to the tail of the tape. You can pause this. Certainly some improvement in the overall technical indicators that we watch. From a stochastic standpoint, all three of the major indexes hooked up. Mid and small are oversold and trying to hook up. RG8 is a mixed bag. NASI RSI oversold, tried to hook up, failed. We don't get the reading until after 6 o'clock, so I'll be looking for that. And We'll see how that goes. The dollar overbought, uh, but made higher highs. Doesn't care. TNX and TYX also near highs. Normally these are negative, but as I said, the correlations were suspended for today. One change, down, the AAII sentiment index, and this is good for bulls, dropped 8 points from last week. You don't want to see sentiment high. That you don't want to see too many people on the wrong side of the boat, bidding the markets up. This is a welcome 8-point pullback for from the bulls. Note it didn't carry over to bears. It just went from bullish to neutral, and so that's like kind of like you got half of what you want. Let's say that. So neutral ticked up by 8 points, bullishness ticked down by 8 points. We certainly can't say that sentiment is overheated. That's the bottom line there. So back above, not committing either to the bull or the bear case. One move back above the 21 and the 50-day moving average. Day count from an 11-day consolidation to up one within a 12-day consolidation. Back above the 8 and the 21 EMA for the first day on the S&P 500. You know, our expectations are positive if both are above the 21E. S&P got back above there today. We'll see how that plays out tomorrow. Triangle breakout, I mentioned that. Three waves, three higher high waves today. Pull back into the close. Sectors today. Dollar stronger and yields, we already mentioned that. 11 out of 11 of the S&P sectors were strong, led by oils, banks, including regional banks, uranium, and coal. On the downside, not much, but silver finished negative. Not a surprise with the dollar, although gold bucked that trend. Gold just mildly higher, along with biotechs and cloud stocks. Let's say they were positive, but they exhibited relative weakness. Let's go to the portfolio. What did we do today? Crowd has been on the 2121 list. We bought a starter position in that today on the 60-minute stochastic cross. Let's point that out here. Bring up crowd, bring up stochastics, bring up the 60-minute chart, and you can see the cross up there. Took a position in that along with that cross. Let's go to the daily chart, and you can see this has had a nice reaction to its earnings report and has had really no give back since then. We've seen a lot of stocks with good earnings reports. They just go sideways since then. This has been exhibiting relative strength during that same period. So a little 2-day break off the top. At this point, all you got, but we were close enough to the 21-day moving average to take our starter position, and that's what we did. What else do we do? Added to Celsius. We took our first 1% on the 60-minute stochastic. Let me go to the 60-minute chart. We took it here last week, 2 days ago. A little bit of a disappointment as of yesterday, as it started out strong and faded. Started out strong and faded again today, but later in the afternoon, some strength came into it. So we didn't quite get back to oversold, but we did get the stochastic cross. We're sitting on the 80 EMA. We're close enough to the 21-day moving average to be able to start and be patient with a small position in this. And by patient, I mean handle pullbacks to the 21 and not trigger our 0.2% of overall portfolio stop level. So we think we can ride that out. Then again, I thought we could ride it out on Fastly, and that didn't work out. And that's a good segue into what we sold today. We sold techs. This was because of the weakness in Apple and the weakness in mostly because of the weakness in Apple. This was offsetting our QLD, our long NASDAQ 100 position. But the strength, Apple was green today, as well as the strength in the NASDAQ 100. We didn't get back above those levels, but it was acting as a drag with the strength in the market. So we took a small loss on TECS, and then Fastly. Now these 60-minute stochastic crosses are not a guarantee. Fastly broke out on great volume of this ascending base 3 weeks ago. We kept our eye on it. We bought it on this stochastic hookup here. Never got back to overbought. That's a bit of a flaw. We would expect it to. And then weakness over the last 3 sessions, broke below the 60-minute stone. We got stopped out on half of it yesterday, right at the 21. Then we undercut the 21 today. Just a little too much selling for this. Sentiment, I don't know if it's sentiment, but whoever was buying has started selling. And below the 21, we hit our threshold of 0.1% on that last 1% we had, and we sold it out. We also, yesterday I mentioned we sold half of our VRT. Got a big upgrade this morning. Where was that yesterday? We sold it when we broke below this the 21 intraday yesterday. We still have the first starter position that we bought on it, and this looks good. This is what you want it to do on the 60-minute. We initially bought it back here, failed beneath the 60-minute, looked like it was trying to get back above it, failed by the end of the day yesterday. That's when we took 1% of it off. And then yesterday, we didn't add it back because we just sold it yesterday and we were focused on a couple of other things. And so we might buy it back, but we've got this 40 resistance level here, and it did show some near-term weakness. So nice bounce at the 21 for now. We still have a small position in that. So those are the portfolio changes. Ticked our beta up to adjusted beta up to 1.52 in the bottom line for the day. Broad rally as stocks ignore the headwinds. That's PPI, the dollar, and yields. So those inverse correlations that have been in place didn't work today. Stocks shook it off, and good stuff. Good broad rally. 11 out of 11 sectors higher, and lets us position a little bit more aggressively and lets us be a little bit more optimistic about what the market is showing us. And as always, we'll see what tomorrow brings. Now, NVIDIA and Uber, our two largest positions. NVIDIA is getting near oversold on the daily. That's good as long as it holds the lows of this week, but didn't really participate in a range breakout today, so mildly disappointing there. However, ARM, a massive IPO in a semiconductor name, that was today, and there's a lot of theories that this is sucking a lot of the liquidity and the volume and the bullishness, or just the money out of other semiconductors and putting it into ARM. If you're a tech manager, a hot IPO comes out, you got to put some money into it. So uh, that may be or maybe not the reason for the recent weakness in NVIDIA. What we do want to see is a move over yesterday's high and a break above the declining 21-day moving average. So that was drug us down a little bit today, along with Uber, which has been acting great for us. Normal pullback for Uber 2 days ago, bounced off the 80 MA, only up a third of a percent today, so lagging the indexes, but stocks are entitled to do that. You can see how the the relative strength line on this is making 2 steps up and 1 step back, and that's just the character of the stock. But we're getting near the top of this cup base. If you want to shorten the rules a little bit, there's a handle with a downtrend line. We broke above that last Friday, followed through on Monday, pull back on Tuesday, bounce at the 8 on Wednesday. Nice tight day today on below average volume Thursday. You know what the bulls want to see if you're an Uber, and we'll be adding to our position if we can break above that level. Energy stocks, NRGU is our preferred way to play energy stocks, and this just keeps going higher and higher. Crude oil is 4 ATR extended above its 21. This is almost 3 ATR extended. It was 3 ATR yesterday when we took a little bit off. If we get another gap up on this tomorrow, we'll reduce a little bit more. And then our last sell will be a defensive sell on a break below the 80 MA. But NRGU has treated us pretty nicely over the last couple of months. What else do we want to look at? I think that's it. So that'll wrap it. So as always, love to hear from you, Don at revereasset.com. If you're on YouTube, we'd appreciate it if you like the video, share it, subscribe to our channel. If you want to call us old school, it's 855 Real Wealth. That's 855 732 5932. We did the podcast a day early. That's out there on YouTube. If you want to check it out, you can also email my partner Dan if you're interested in becoming a client. I've had quite a few people reaching out lately. We're very grateful for that. That's why we do these videos, to get the word out there that you don't have to be a slave to the markets. You can protect your downside and still participate when the markets are rallying. Email dan@revereasset.com if you're interested in that. And with that, I'm going to wrap up the video for Thursday, September 14th. Of course, remember, it's not how much you make in the markets, it's how much of that you can keep. This is Don Vandenbord with Revere Asset. Thanks for listening and have a great day.